to Ingenomics. In the past 2 weeks, the world has been buffeted by news of slowdown in all major economies. The US economy has seen bad home sales data and poor consumption, manufacturing and job numbers. The Chinese economy too has been shocking with a slowing pace. How much worse does it get from here? We ask Andrew Freris, the Chief Investment Strategist for BNP Paribas. He joins us from Hong Kong. Dr. Freris, welcome. Let's start with the country closer home for you, the Chinese economy. Bad conference board numbers and bad manufacturing numbers. How much slower does it get for China?
I think it's very important to put these things in perspective. The Chinese for the last 2.5 years have actually said they want to slow down the economy. They have instituted very strict financial and credit controls, particularly towards the property sector. And when the economy slows down, everybody's surprised. Hello? Of course it's slowing down. So I have absolutely no problem whatsoever with both the Purchase Managers Index and the Chinese output growth of them slowing down. And if the economy first quarter grew in excess of 11%, if it grows at 10% now, absolutely no problem whatsoever. I have no idea what the fuss is about, but the markets obviously are taking it very badly. Actually, the market should be taken very badly because Chinese monetary policy is tight and it is working. And that's why China has got the best economy in terms of growth virtually anywhere in the world, and it has got a stock market which is now competing with Greece. I'll say that slowly. It is competing with Greece as being one of the worst performers year to date.
Oh, absolutely. Dr. Freris, then let's turn to the US. How would you interpret the US data? Is it headed for a double dip, and how long can this poor run last?
Again, the GDP growth in the United States for the first quarter, and very likely on the second quarter, was primarily driven by government spending. So it's not really surprising that there is not enough, if you want, steam in the economy to sustain it. And also we have known it for a long time that the property sector that started it all was running out of steam very, very rapidly, particularly because, again, it was being supported by tax credits, which ran out in April, May. And then, of course, now both new home sales, new startup in construction are only coming down very, very rapidly, as if this is any surprise again. You know, if the economy runs because at the back of fiscal initiatives, when these dry up, the economy stops running. Very, very simple. So the answer is yes, the outlook is not particularly good unless there are further fiscal initiatives, which they are, and this is simply going to worsen the fiscal deficit of the United States. And remember, now we have moved very rapidly from the crisis in the private sector credit to the crisis in the sovereign sector credit.
Well, actually, that's a little surprising. Are you saying that there is no headroom for a stimulus? After all, US 10-year bonds are at record lows of 2.9, I think even lower. There seems to be appetite for US bonds, isn't there?
We have, again, to differentiate two aspects. One of the reasons of the flattening yield curve is, of course, that short-term interest rates have been artificially kept down to zero. And, of course, with the European sovereign credit crisis, there was a rush to safety, only to find out that the United States is not going to be any safer than any other country which has its fiscal deficit go from 400 billion just before the crisis to nearly 1.3, 1.4 trillion within 2 years, and pushing very rapidly around 10% of GDP, not significantly different from that of Greece. So I see the flattening of the US yield curve has been a temporary result, a temporary effect, and not good news at all.
So then when do you think investor appetite could run out even for US bonds?
Well, when it slowly dawns on to people that you cannot cure one credit bubble by creating another one, okay, then we're going to see. And then people mix up the notion that if you move away from US government bonds, you move away from US dollar. No, you don't. I'm just joking now. You can buy at Disneyland and you can buy Mickey Mouse, and you're still in US dollars, but you're not buying US government bonds.
Well, if US and China are slowing, as you are saying, what happens to commodities as an asset class? Will they be able to reach the highs they saw earlier in 2010, or is the peak over, at least for 2010?
Very much so, in fact, and one of the reasons why we are now seeing a fairly consistent weakness on the Aussie dollar. Don't forget, until 2 months ago it was trading at nearly 90. It is now within kissing distance of 83. It's precisely the slowdown in China, who is a very important consumer at the margin, And of course, Japan, Europe, and the United States are other major consumers. Let's not forget, even in the case of oil, the United States still consumes about 25% of total output of oil in the world. Again, all these commodities are going to face a significant weakening in their demand, and therefore prices are likely to weaken as well.
Well, let me shift focus to the Indian economy. It has so far shown resilience. Even the stock market has outperformed Asia and Wall Street. What's your forecast on the Indian economic growth and the markets as well, given that the global economy is taking a turn for the worse?
Let's split up the answer in three parts. First, India is not dependent on the world economy. That's another nice, convenient little lie. There are certain industries in India that are very much export dependent, but the Indian economy altogether, again, with about 15% of GDP going to exports, is not dependent at all on exports. Net exports make a tiny contribution to India's GDP, so we can forget about this effectively. Again, individual industries may be export dependent, but India is not export dependent. The second part is the Reserve Bank of India has been running a tight monetary policy coming up for 6 months, and it will continue to do so. We just had the WPI number, and even the manufacturing production number, which decelerated a little bit but still is substantially high, points out that the economy is growing, and it's growing quite satisfactorily. And the reason, of course, why the stock market is not performing well is terribly simple. All Asian stock markets, in one way or another, reflect the flow of funds, the global flow of funds, which take their lead from what's happening to the S&P, and so will the Sensex. And, of course, there is tight monetary policy. That hasn't gone away.
Well, actually, I was coming to the fund flows issue. Do you expect this, dwindling fund flows into Asian and Indian equities to continue in the second half, or could fund flows reverse?
Well, let's again split the answer in two parts. The overall performance of equity markets in Asia, and that includes India, reflected to a great extent what has been happening in the G3 economies, with two huge exceptions. One is Indonesia, which is the best performer in Asia so far this year. Stellar performance, nearly 20% in US dollar terms. And the second one, take a deep breath. Surprisingly, it's Thailand. The military coup, with bloodshed in the streets, with still political uncertainty. So the macroeconomics, consumers' expectations and outlook have now completely decoupled from the performance of markets. So frankly, in terms of buying or not buying Asia in an environment where the G3 equity markets will continue to perform very, very poorly, I will be very, very cautious. And if I would buy only on the basis of relative value, and the Indian stock market is by no means one of the cheapest.
In that case, what asset class should smart money chase at all? And in any case, when would you buy India?
We'll be buying India markets when it is very clear that the Reserve Bank of India has stopped tightening monetary policy. And this perhaps might not be, again, the time for perhaps another 9 months or so, because in all probability the RBI might wish to see one further increase in interest rates. And whilst this is overhanging, credit will continue to be tight. And the second part, where the smart money will be, most definitely, as you appreciate, we're not very bullish on equities. Unfortunately, fixed income still offers some potential good yields, not government bonds. I have to emphasize that, and most definitely not U.S. government bonds, because we do expect that they are very significantly overpriced now, very, very expensive indeed. But corporate bonds, particularly Asian corporate bonds, and particularly Asia sovereign bonds that are backed by cast iron economies, and they have absolutely no issues of default or any specific credit-related problems, will continue to perform relatively better than those of U.S. government bonds.